silver could shock the world like GameStop. Here's why. Before you click away, before you open another chart, before you jump to the next headline, ask yourself one simple question. What if the biggest silver move of this decade starts when almost nobody is paying attention? So take a breath, slow down for a second, and really focus. Because this is not a hype video, this is not a get-rich-quick pitch, and this is definitely not financial advice. This is about understanding market psychology, hidden pressure, and why silver has a history of shocking people when expectations get too comfortable. If you've ever missed a big move and later thought, I knew something was coming, but I didn't act early enough, then this video is for you. And if you're new to silver, stay with me, because by the end of this video, you'll understand why some analysts are quietly comparing today's silver setup to moments that caught the entire financial world off guard. So don't scroll, don't skip ahead. Give me just a few minutes of your attention, and let's break down what's really happening in silver right now before the crowd notices. While everyone is busy watching AI stocks, crypto volatility, and central bank decisions, a quiet shift may already be happening inside the silver market. And if history teaches us anything, it's that the biggest moves often begin when nobody's paying attention. You probably remember the GameStop phenomenon. A moment when retail investors challenged Wall Street expectations, short sellers were forced to react, and price movements turned into a psychological storm that nobody predicted would grow so powerful so quickly. Now imagine a global commodity, deeply connected to industry, technology, and monetary systems, starting to attract similar attention. Not because of hype alone, but because underlying supply pressures, rising demand from solar and electronics, and changing investor sentiment are slowly aligning at the same time. Some analysts believe silver could be entering a phase where perception and reality begin to collide, where years of quiet accumulation meet sudden awareness, and where a shift in narrative alone could trigger momentum strong enough to surprise both institutional traders and everyday investors. But is this comparison to GameStop realistic? Or is it just another exaggerated story designed to create excitement around a volatile asset? In this video, we're going to break down the real data behind silver's market structure, explore whether a true squeeze scenario is even possible, analyze the psychology that drives explosive moves, and uncover why the next big shift in silver might arrive faster than most people expect, and why being early to understand it could change the way you see the entire precious metals market. What happened with GameStop? Psychology. To understand why some analysts compare silver to GameStop, we first need to understand what actually happened during the GameStop phenomenon. Because it wasn't just about a stock price going up, it was about psychology, crowd behavior, and the power of narrative in financial markets. GameStop started as a struggling retail video game company that many hedge funds believed would continue declining, which led to extremely high levels of short selling. Short sellers were essentially betting that the price would fall, creating a situation where more shares were sold short than many people thought was sustainable. At the same time, retail investors began gathering on online platforms like Reddit, sharing research, memes, and a shared belief that Wall Street was underestimating both the stock and the power of collective action. What started as discussion quickly turned into momentum, and momentum turned into conviction. Psychologically, this created a powerful shift. Retail investors no longer felt like individuals trading alone, but part of a larger movement challenging institutional dominance. This emotional connection fueled buying pressure that wasn't purely based on traditional valuation models, but on belief, narrative, and the idea of participating in something historic. As prices started rising, short sellers were forced to cover their positions to limit losses, which pushed prices even higher. This feedback loop is known as a short squeeze, and it amplified volatility dramatically, creating rapid price movements that shocked both professional traders and mainstream media. Another key psychological factor was fear of missing out, or FOMO. As headlines spread and social media amplified gains, more investors rushed in, not wanting to miss the opportunity, which added additional momentum and turned the event into a global financial spectacle. However, it's important to understand that the GameStop event was not just about retail investors versus hedge funds. It was about how collective psychology, narrative shifts, liquidity conditions, and market structure combined to create an explosive situation where expectations broke down and volatility dominated decision-making. Why people compare silver to GameStop. After understanding the psychological storm behind GameStop, the next question naturally becomes, why are some investors even comparing silver, a global precious metal, to a meme stock event? At first glance, the comparison may seem strange because silver is not a struggling company or a niche stock. It is a globally traded commodity with deep industrial and monetary roots. But the comparison isn't about the asset itself. It's about market structure, positioning, and crowd psychology. One major reason comes from discussions around short positioning in the silver futures market. Some analysts and retail communities believe that silver has historically seen significant paper trading compared to physical supply, which creates debates about whether a sudden surge in buying pressure could force rapid price adjustments, similar to a squeeze dynamic. Another factor is the power of retail investors coordinating through social media. The GameStop event demonstrated that large groups of individual traders can move markets when narratives spread quickly and momentum builds. And since silver already has passionate investor communities, some people believe a similar wave of attention could create strong upward pressure. Unlike GameStop, however, silver has real-world industrial demand tied to solar energy, electronics, artificial intelligence hardware, and green technology infrastructure. This means that any surge in investment demand could potentially combine with existing fundamental demand, creating a different kind of market reaction compared to a purely speculative meme stock rally. There's also a historical angle, because silver has experienced explosive moves in the past, where prices accelerated rapidly once momentum began, reinforcing the idea among some traders that silver is capable of sudden and dramatic price action when sentiment shifts. However, expert analysts also emphasize that silver's market is much larger and more liquid than a single stock, which means comparisons to GameStop should be understood as psychological analogies rather than direct predictions. What could trigger a silver shock? Now that we understand why some people compare silver to GameStop from a psychological perspective, the next question becomes far more important. What specific events or conditions could actually trigger a sudden and powerful move in the silver market? One of the biggest potential triggers is a rapid surge in retail investor interest. The GameStop phenomenon showed how quickly momentum can build when a narrative spreads across social media platforms. And if silver suddenly becomes the focus of online discussion again, increased buying pressure could accelerate price movements beyond what traditional models expect. Another key factor is institutional positioning. Large hedge funds, banks, and asset managers play a major role in the silver market through futures and derivatives trading. If market sentiment shifts and these institutions begin adjusting their positions at the same time, even small changes in allocation could create significant price volatility due to the scale of capital involved. Supply constraints also represent an important catalyst. Unlike digital assets, silver is a physical commodity with mining limitations, production costs, and logistical challenges. If industrial demand from solar panels, electric vehicles, advanced electronics, or AI infrastructure continues rising, while supply growth remains limited, the market could experience structural pressure that amplifies price reactions during periods of increased investment demand. Macroeconomic uncertainty can act as another powerful trigger. Inflation fears, currency instability, geopolitical tensions, or declining confidence in traditional financial systems often push investors toward precious metals, and silver historically benefits from both its monetary identity and industrial usefulness during uncertain economic environments. Short covering dynamics could also accelerate moves if traders betting against silver are forced to close positions during rapid price increases. This type of feedback loop can create sharp upward momentum, although experts caution that such scenarios depend heavily on market conditions and liquidity at the time. Finally, the most unpredictable trigger is narrative itself. Markets don't always move purely on data. Sometimes a shift in collective belief, the idea that something big is coming, becomes the catalyst that turns slow accumulation into explosive action. If silver does explode, what happens next? So what happens if silver actually experiences a powerful breakout or shock move similar in intensity, though not identical, to past market surprises, like GameStop or historic precious metals rallies? The first thing investors would likely notice is speed. Silver has historically moved faster and more aggressively than gold during strong bullish phases because its market is smaller and more volatile, meaning price reactions can accelerate rapidly once momentum begins. As prices start rising, momentum traders and algorithmic systems could amplify the move. Many trading strategies are designed to follow trends, and once technical resistance levels are broken, automated buying pressure can add fuel to an already accelerating market. Next comes the psychological phase. Media coverage increases, social media discussions expand, and retail investors begin noticing headlines about sudden gains. This creates a classic feedback loop where attention drives demand, and demand drives more attention, potentially pushing prices higher than fundamental valuations alone might justify in the short term. Another major impact could be seen in related markets such as silver mining stocks and exchange-traded funds. Historically, mining companies often experience even larger percentage moves than the metal itself because investors expect higher profitability when commodity prices rise sharply. Industrial sectors might also feel the effects if silver prices surge significantly. Because silver is used in electronics, solar panels, medical devices, and advanced technologies, higher prices could influence production costs and supply chain decisions, adding another layer of economic complexity beyond just investment speculation. However, explosive moves also bring volatility. Rapid rallies are often followed by sharp corrections as early investors take profits and late entrants face emotional decision-making under pressure. This means that while a silver shock could create opportunity, it could also increase risk for traders who chase momentum without understanding market structure. Ultimately, if silver enters an explosive phase, it would likely become one of the most talked about assets globally, attracting both serious investors and speculative capital. And history shows that when attention reaches peak levels, the market narrative itself becomes one of the strongest forces driving price action. So when we step back and look at the bigger picture, the comparison between silver and GameStop isn't about predicting the exact same event. It's about understanding how markets behave when psychology, positioning, and narrative suddenly align. Silver is not just another asset. It sits at the intersection of monetary history and industrial innovation, meaning that any major shift in investor perception could transform it from a quiet commodity into one of the most volatile and talked about markets in the world. History shows us that explosive moves rarely announce themselves early. They begin quietly, building pressure while most investors focus on other headlines, and only later do people realize that the opportunity, or risk, was already forming beneath the surface. The real question isn't whether silver will become another GameStop, but whether investors understand the forces that can turn slow markets into fast ones: supply constraints, institutional positioning, retail momentum, and the powerful role of collective belief. If a silver shock ever happens, it won't just be about price, it will be about how narratives change, how investors react emotionally, and how quickly financial markets can shift from calm to chaos. And that's why understanding these dynamics today could be more valuable than trying to react tomorrow when the move has already started. Thank you for watching, and if you want deep, expert-level analysis on gold, silver, and global markets, make sure to subscribe, turn on notifications, and join this community where we break down complex financial events into clear, powerful insights.